Picture this, you've just received your end of year accounts and there's a whopping great big depreciation charge in there. Now, for those of you not particularly versed in accounting, depreciation is the write-off of fixed assets that you might have bought. So that's things that you'll use for future economic benefits, like vans, plant and machinery, fixtures and fittings, computer equipment, that sort of stuff. And you capitalise that on your balance sheet. Now, back in the day when I was working in accountancy practice, you tended to have a couple of depreciation methods. 33% reducing balance, 25% straight line tended to be the two main ones. Other depreciation rates are available. So if you've got a whopping great big depreciation charge, question it. Because ultimately depreciation is the write-off of the asset over its useful economic life. And if actually that economic life of the asset is 10 years, we should be writing it off over 10 years. Conversely, if you've bought something and you think, right, after 3 years we're going to change it up and get something new, what is the value of that asset going to be after 3 years? So residual value is what that's called. So you would write off, say it was a 20 grand piece of kit, and in 3 years it's still going to be worth 10 grand. You're not going to write off £20,000 in your accounts. You're going to write off 10 over 3 years. Which means ultimately you'll have a less of an impact on your profit and loss, which will boost reserves in the company. So if any of this maybe rings a bell or has made you sort of question how the depreciation is being calculated in your business, perhaps that's where you need to get someone like us involved to help with, one, do the bookkeeping, and two, possibly look at doing some management accounts so you can keep a track of the value of your assets. That's all from me today. Cheers everyone, bye.